The financial world can feel like a roller coaster. One day the stock market is hitting record highs. The next it plunges, leaving investors anxious, uncertain, and questioning every decision. If you've ever felt like the market is too risky, you're not alone. Many people shy away from investing during volatile periods because they fear losing their hard-earned money. But here's the truth: you don't have to take extreme risks to grow your wealth. There are proven strategies that allow you to make your money work for you while minimizing risk even when the markets are unpredictable. Today, we'll explore practical ways to grow your money in a volatile market without sleepless nights or reckless decisions. The first step is understanding diversification. Diversification is not just a buzzword, it's the foundation of minimizing risk. Instead of putting all your money into a single stock, sector, or asset class, diversification spreads your investments across multiple areas. Think of it as not putting all your eggs in one basket. When one investment loses value, others may gain or remain stable, balancing your overall portfolio. This doesn't eliminate risk entirely, but it significantly reduces the impact of market swings. For example, combining stocks, bonds, alternative assets can create stability while still offering growth potential. Investing in bonds is another key strategy for minimizing risk. Bonds are essentially loans to governments or corporations that pay interest over time. They tend to be less volatile than stocks and provide a steady stream of income. In times of market uncertainty, bonds often act as a safety net because they are less influenced by market panic. Government bonds, in particular, are considered extremely safe, offering predictable returns even when stock markets tumble. Incorporating bonds into your investment strategy ensures your portfolio isn't entirely dependent on stock performance. Dollar-cost averaging is a powerful technique that helps investors navigate volatility without guessing market timing. Instead of investing a lump sum all at once, you invest a fixed amount regularly regardless of market conditions. When prices are low, you buy more shares. When prices are high, you buy fewer. Over time, this method smooths out the effects of market swings and reduces the risk of investing a large amount at the wrong moment. It's simple, consistent, and highly effective for long-term growth, making it ideal for both beginners and seasoned investors. High-yield savings accounts and certificates of deposit (CDs) are underrated tools for growing money with minimal risk. While they don't offer the explosive growth of stocks, they provide safety and steady returns. High-yield savings accounts give you liquidity. Your money is easily accessible while offering interest that compounds over time. CDs lock your money for a fixed term at a guaranteed rate, protecting it from market fluctuation. These tools are particularly valuable in volatile times because they provide predictable growth and preserve capital. Dividend-paying stocks can also play a role in minimizing risk while growing wealth. Unlike growth stocks, which rely entirely on price appreciation, dividend stocks provide regular income regardless of market conditions. Companies that consistently pay dividends are often well-established, financially stable, and less likely to experience extreme swings. Reinvesting dividends can accelerate wealth accumulation, creating a steady compounding effect over time. Even during market dips, dividend payments continue, offering both income and reassurance to investors. Investing in index funds, or exchange-traded funds, ETFs, is another low-risk approach for market volatility. These funds track the performance of a broad market index, like the S&P 500, spreading risk across hundreds of companies. Because they are diversified by nature, index funds reduce the impact of any single company's poor performance. ETFs offer similar benefits with added flexibility, as they can be traded like stocks throughout the day. Both options provide low-cost exposure to the market, making them ideal for investors who want growth without taking on excessive risk. Emergency funds are a hidden but essential part of a risk-minimizing strategy. Market volatility can be stressful, especially if you might need access to cash in the short term. By keeping 3 to 6 months of living expenses in a liquid, easily accessible account, you reduce the pressure to sell investments at a loss during a downturn. Knowing you have an emergency fund gives you the confidence to let your investment grow undisturbed, even when the market takes a temporary dip. It's a psychological safety net that protects both your money and your peace of mind. Alternative investments can also help balance risk. These include assets like real estate, commodities, and precious metals. While they may not provide the same rapid growth as stocks, they often move independently of traditional markets, offering a buffer during volatility. Real estate, for example, provides tangible value and potential rental income, while gold or other commodities can act as a hedge against inflation. Including these alternatives in a portfolio can create additional layers of security, helping you grow money steadily when traditional markets fluctuate. Regular portfolio rebalancing is another essential practice. Over time, market movements can shift the balance of your investments, making your portfolio riskier than intended. Rebalancing involves adjusting your holdings to maintain your desired allocation. For example, If stocks perform well and now represent a larger percentage of your portfolio, selling some and reinvesting in bonds or cash equivalents brings your allocation back in line with your risk tolerance. Rebalancing ensures your portfolio stays aligned with your goals and protects against unintended overexposure to volatile assets. Investing in yourself is a low-risk strategy that often gets overlooked. Skills, education, and knowledge are assets that grow your earning potential without depending on market performance. Whether it's learning new skills, pursuing certifications, or expanding your expertise, investing in yourself increases your income capacity. Higher earnings allow you to save and invest more, compounding your financial growth without exposure to market fluctuations. Unlike stocks or bonds, your skills and knowledge can't lose value overnight, making this one of the safest forms of wealth building. Safe haven assets such as government-backed securities or treasury inflation protected securities tips are particularly valuable during volatile times. These investments provide guaranteed returns with minimal risk of loss, protecting your capital from market swings. While the returns may not be as high as aggressive growth strategies, the safety and predictability they offer can stabilize a portfolio and allow other investments to grow without pressure. They act as anchors in a stormy market, giving investors both security and flexibility. Avoiding market timing is a crucial principle for minimizing risk. Many investors make the mistake of trying to buy low and sell high, reacting emotionally to market headlines. This approach often leads to losses because predicting short-term movements is extremely difficult, even for experts. Instead, focusing on long-term growth, consistent investing, and maintaining a diversified portfolio mitigates the temptation to make impulsive decisions. Patience and discipline are more valuable than trying to outsmart market volatility. Using dollar-cost averaging for high-risk assets further reduces exposure to volatility. By investing fixed amounts at regular intervals, you automatically buy more when prices are low and less when prices are high. Over time, this reduces the average cost of investments and diminishes the impact of market swings. Combined with diversification, asset allocation, and rebalancing, dollar-cost averaging forms a robust strategy to grow money steadily without unnecessary risk. Tax-efficient investing is another often overlooked factor in minimizing risk. Using accounts like Roth IRAs, 401ks, and other tax-advantaged vehicles allow investments to grow without being immediately taxed, amplifying compound growth. By reducing tax liability, you maximize returns and reduce the pressure to make risky decisions to cover expenses. Tax efficiency ensures that your money works harder for you, making your portfolio more resilient to market ups and downs. Psychological resilience plays a hidden but vital role in minimizing risk. Emotional reactions to market fluctuations, fear, greed, panic can lead to poor decisions like selling during a downturn or chasing hype. By maintaining a calm, informed mindset, investors avoid costly mistakes. This is why education, planning, and having a clear strategy are essential. Confidence in your plan allows you to hold investments through volatility, giving them time to grow while avoiding unnecessary losses. Finally, consistency over time is the most powerful principle. Even minimal-risk investments grow significantly if maintained over years or decades. Compounding works quietly, steadily increasing wealth while risk remains controlled. Every month you invest, every dividend you reinvest, and every disciplined financial decision compounds into substantial growth over time. The key is to remain patient, focused, and committed to your plan, letting time work in your favor rather than reacting impulsively to temporary market noise. So, start today. Diversify your portfolio, allocate your assets wisely, invest consistently, and stay disciplined. Use bonds, dividend stocks, and safe haven assets to reduce risk. Invest in yourself, rebalance regularly, and avoid the trap of emotional decision-making. Over time, these small, intentional actions compound into significant wealth growth. A volatile market doesn't have to be frightening. With knowledge, strategy, and patience, it can be a powerful tool for building financial security and prosperity. Remember, it's not about getting rich quickly. It's about growing your money steadily, safely, and consistently, even when the world around you is unpredictable. By following these principles, you protect your hard-earned money, reduce risk, and position yourself for long-term financial success. The market will always fluctuate, but your disciplined approach ensures that your wealth continues to grow, even in the face of uncertainty.